Does dollar cost averaging into Bitcoin still work? In fact, has it ever worked? Yes, and probably much better than you'd think. Where better to start than the dollar cost averaging tool we've just added on lookintobitcoin.com, available for new subscribers. So I've just altered this slightly to say a $100 purchase amount every month. And to begin with, we're going to look at the 5-year performance in doing so, and then the 9-year performance in doing so. And we're going to try and expand on just plain dollar cost averaging and compare the results to see if we can optimize this any further. And what we can see is dollar cost averaging over the past 5 years for BTC will have turned a $6,100 investment into nearly $13,000, over a 100% return and over 20% annual returns, which would far beat Warren Buffett, the best investor who's ever lived. So not a bad strategy, and so simple. If we're just potentially buying a set amount of BTC on the last day of every month, $100 for example, this returns pretty well. In fact, it beats pretty much every other baseline metric, and especially for something so simple, you can't really go wrong, especially if your goal is to just accumulate as much BTC as possible. But do we think we can expand on this performance? Do we think we can implement some other tools, look for confluence in other metrics to really improve on this and to maximize our profit potential? So for this idea, I wanted to keep things again in the spirit of simplicity and make this something someone could very easily implement. So I've just used the Bitcoin Investor tool for this part, and really what we're going to be doing by implementing this is only dollar cost averaging into positions once we see Bitcoin beneath this green line on the Bitcoin Investor tool, which is the 2-year moving average. So the way I've actually calculated this, because I've done all the maths and I've got all the numbers behind this, is if you were to have started 5 years ago or 9 years ago, like we said on the dollar cost averaging strategies, and you only actually bought at the end of the month, but had saved up potentially from not purchasing when Bitcoin's price is above this green line and gone all in with a purchase once we'd actually dipped beneath. So if we just, for example, go to the 2018-2019 cycle here, you'd have accumulated your $100 a month every month since 2015, since Bitcoin was above this green line. 2016, sorry. And then you'd have purchased a huge bulk amount on November 31st, 2018, and then December, January, February, March, April, you'd have just bought $100 at the end of every month. So all the money you save between them, you're just bulk buying at the first opportunity, the first dip beneath. So again, this is very simple. This isn't looking at the most optimal way. I'm almost certain you could find a more efficient strategy pretty simply. Like I said, we're going to do a quick comparison. So if we look to the 5-year performance, so starting on September 30th, 2018, you wouldn't have actually bought then, you'd have bought $300 worth on November 31st at $3,971.62, and you've continued that trend all the way until today. Bitcoin, just blind dollar cost averaging, would have returned, like we said, 112.25%, but timing your dollar cost average investments using this simple tool would have actually only returned 113.89%. It'd have turned that original investment into $13,047. So only about $100 more than just blind dollar cost averaging, which might be a little surprising because you'd think investing at what seems to be the most opportune, highest risk to reward, discounted BTC moment would really massively improve your performance when dollar cost averaging in. And if we go to the 9-year, it becomes even a little bit more apparent. So the same strategy, $100 at the end of every month. Buying BTC since 2014, September 2014, would have returned 2,069.87%, just blind dollar cost averaging. But if we were to implement, like we said, the strategy we said before, so you'd have saved up a few $100s and purchased your first amount on December 31st, 2014. So it would have actually turned your initial investment of $10,900 into just over $190,000 for about 1,750% return, which is actually less than just blind dollar cost averaging, which is maybe surprising, maybe it's not surprising, but why is this occurring? Because surely accumulating at the most opportune moments and saving up so you're not purchasing Bitcoin at far, far higher prices is a much more efficient strategy. Well, really, it's because even though Bitcoin bottomed out at around $3,500 after the 2017 into 2018 cycle, really, if you were accumulating all the way up, you'd have had months and months, years even, to accumulate BTC at lower prices. And again, even once Bitcoin topped out at above $60,000 towards $70,000 and bottomed out again at around $15,000, you'd have had months and months, years again, to accumulate actually lower than the next cycle low. So blindly dollar cost averaging in these circumstances actually outperforms implementing a basic strategy like this one. Of course, like I said, this is a simple strategy, but can we maybe improve on this? Can we maybe do something else to try and far outperform just dollar cost averaging? This is where we need to consider profit taking. Blind dollar cost averaging, like we said, for just plain flat out accumulation of as much BTC as possible makes sense. If you're not willing to take profit, if you don't want to take profit or sell any of your position, then blind dollar cost averaging outperforms just trying to time the market too specifically, at least in some circumstances. On the shorter time frames, actually accumulating beneath that investor tool performed slightly better. But like we said, it's comparable. What we really need to look for to improve this performance is profit taking. So again, in the spirit of simplicity, I've just looked to one of the most intuitive metrics we have, which is the Bitcoin MVRVZ tool. And now this is looking at the relationship between the Bitcoin market cap and the realized price. And once we actually divide them and standardize for volatility, we get this MVRVZ score, which gives us very clear indications of buying and selling BTC. Now, it may have actually been better to accumulate during these green buyers on the MVRVZ score, but I wanted to try and collate two different indicators. But the way I'd use this is for profit taking, and not necessarily just so we've ensured profit taking at the highest price. No, what I've done is I've waited until the MVRVZ score has dipped into this red sell area and then exited back beneath. So in this 2017 cycle, we'd have actually sold it closer to $16,000, which is quite a bit beneath the actual peak we set. And I did the same for the most recent 2021 cycle. Again, this was far beneath the all-time high, which was close to $70,000. This was selling once we dipped up into this sell zone and crossed back out when price was at about $55,000. So definitely not the most opportune, most efficient point of profit taking. But again, just to keep things simple and really outline how much just combining two very simple metrics can potentially outperform. So how does accumulating when Bitcoin is under that investor tool line and selling at the MVRVZ score compare to dollar cost averaging? Well, on a 5-year basis, if you were to have taken profit, like we said, at the peak of the 2021 cycle, according to the MVRVZ score, not the actual all-time high, you'd have taken profit of $19,862.94. Now, this is substantially higher than just the profit you'd have made from just accumulating. Just the taking profit, and that's excluding over a year and a half of price action. If you look to how much you'd have actually accumulated to today, it'd be $29,221.70, and you'd have amassed 1.129 BTC in the process. So as opposed to this 112.25% returns on your $6,100, you'd have actually made closer to 380% profit, over 3 times the performance, which is a substantial improvement. But what if we look to a 9-year basis rather than the 5-year? This gives us 2 opportunities to sell on the MVRVZ score, not just in 2021, but also in 2017 at about $16,000 once we got that sell signal on the ratio. So again, comparing to the 9-year value where we returned 2,069% or turned $10,900 into $236,000. Again, not too bad, but if we were to have accumulated under the 2-year moving average and taken profit when the MVRVZ score crossed out of the sell area, on that initial sell would have banked over $100,000 on our profit taking, which is incredible. And then if we'd have reinvested that and again done the same thing throughout the next cycle, we'd have turned that original $10,900 into $842,000. Over $600,000 difference from just 2 additional trades, which returns 7,626% returns, which is astronomically better than just blind dollar cost averaging. And I know what you're thinking, if I'd have just implemented blind dollar cost averaging and still taken profit at those points, would that not have returned similar amounts? Well, actually, no. If you'd have blind dollar cost averaged, because of the effects of compounding, if you don't reinvest at the most opportune moments, it actually massively hinders your profit potential. In fact, blind dollar cost averaging and taking profit at the same point will have only returned about 48% of the amount of investing at those most opportune moments. Also, if you haven't already, please don't forget to like this video, subscribe to the channel, and turn on notifications to ensure you're receiving all of our content as soon as it's released. And make sure to check out all the resources we've discussed today, as well as the many more that are all available on lookintobitcoin.com, your number one source for Bitcoin information. So just to summarize, dollar cost averaging is the process of drip feeding capital into your investments as opposed to trying to time your single entry purchases. And as we've seen, dollar cost averaging does make sense. Timing the market is very hard, and especially if you're accumulating as much Bitcoin as possible with no intention of selling or ever taking profit, it's really hard to beat dollar cost averaging, especially due to its simplicity of just buying a fixed amount regardless of price at set intervals. However, like we've seen, if we implement a number of unbiased and simple data points to help us not only invest at the most opportune moments, but to also help us better time our profit taking, as well as implementing some compounding with those realized profits, we can improve our profit potential exponentially. And like I said, this was one of the quickest, most simple, easy to implement methods of accumulation and distribution I could come up with. I'm almost certain you could come up with a much more efficient strategy to find confluence between multiple different metrics that we provide to really ensure you're accumulating BTC when it's at a heavily discounted price and ensuring you're taking profit and selling at the best, highest prices possible. And combined, those are really, really hard returns to beat. If you like this video, then please visit lookintobitcoin.com, where you can also consider becoming a site subscriber to gain access to professional resolution charts, advanced macro and portfolio data tools, in-depth crypto industry reports, live and personalized indicator alerts, private TradingView scripts, and more, all for a fraction of the standard industry price. And let me know in the comments down below and on social media, are you dollar cost averaging into your positions? Are you dollar cost averaging out of your positions? Let me know your investing philosophy and thesis. I look forward to reading and replying to all of them. Thank you very much for watching, and I'll see you in the next one.